Hi everyone, welcome to the latest episode of Artemis Live. Given the time of year and given we're now officially into the hurricane season and already 3 tropical storms down, we thought it would be very interesting to speak with RMS. RMS are one of the leading catastrophe risk modelling data and analytics firms in the world, one of the main companies used by underwriters in the reinsurance and insurance-linked securities space to better understand the perils that they are allocating capital to. Delighted to be joined by Jin Shah, who's Managing Director, Capital Markets and Resilience, and also Jeff Waters, who's a Senior Product Manager, and I believe has a focus on the hurricane peril, which is timely. So thank you both for joining me.
Thank you, Steve, for having us.
Yep, thanks for having us.
Sure, it's great to see you both. So it's looking like an interesting year potentially. As we all know, forecasts are indicative only of the potential for storm formation, and storm formation doesn't necessarily equal large loss impacts for the industry, but the forecasts do suggest an above average level of activity through 2020 in the Atlantic, and there's other people pointing towards higher surface temperatures in the Gulf and off the southeast. So what's your view at RMS on this, and what do you think this means for sort of ILS and reinsurance as we go through the season this year?
Sure, yes. So from a pure science standpoint, as you mentioned, there's a lot of contributing factors to the above average hurricane season that's being forecast by a number of agencies and organizations. We're seeing warmer than average sea surface temperatures in the tropical Atlantic, and forecasts for La Nina conditions to evolve, especially into the fall during the peak part of the hurricane season. All those conditions would certainly make it more conducive for tropical cyclones to form, develop, and track throughout the basin. So, as you mentioned, though, higher activity does not always translate into a higher number of landfalling storms. At the same time, it only takes one event to really drive significant losses through from the insurance all the way through to the reinsurance and ILS markets.
Absolutely, yeah. Jin, from the market's point of view.
Yeah, and just to add to that, the ILS market is there to take losses, and that's the trade-off for earning a premium or spread. And what they're trying to do as best as possible is avoid the surprise losses. That they're the ones that cause a headache. And, an example of that is where you've got a probability of attachment, which is a 1 in 200. And the 1 in 15 event is the one that causes the loss, right? So, and what I'm really pleased to see is the ILS market making a real investment in the analytical processes and workflows that will result in an underwriting process that hopefully mitigates against those surprise results. And so I've seen that investment happen in a number of ways. We've got a number of new types of roles that have entered the market. We've got head of analytics and head of tech. And as a consequence, they're taking a deeper look at the technology that they're licensing, so making the most of their vendor licenses. They're embracing the cloud, and I think that's going to be a little bit of a no-brainer once we're out of the lockdown. And taking a better look at the data that's available in-house. There's a wealth of data there, which I think in the past may have been underutilized, and I think they're taking a closer look at that and using that to draw better insights into the underwriting process. Just to give you a very quick example of what I saw just before the 1/6 renewals, one particular ILS manager came to us, and they had already identified 5 programs that are exposed to US hurricane, and they wanted to take a deeper look at those programs. So we were able to spin up a very quick service using our teams in India. These guys are experts in analyzing exposures and running analyses. And we were able to re-geocode those exposures, look at the data quality, enhance the exposures. So, look at missing data and filling it in, correcting things that might have been incorrectly coded. And then we were able to apply the manager's view of risk. And so we were able to run analyses with secondary modifiers switched on and off, post-loss amplification switched on and off. And so what that meant is that when it came to the underwriting decision, instead of looking at just the one data point that's available in the submission, now they had a set of data points. And I hope through that process they were able to make a much better decision on whether to write that deal or not, and ultimately avoid the surprise loss, which I think is the one thing that will normally causes a headache during the season.
Sure, absolutely. No, that sounds like a very forward-thinking ILS manager, and it's encouraging as well. Because there was actually a report out today about Lloyd's companies saying how the return on investment from better portfolio management, largely through the use of data and better analytics, has about a 300% ROI on the investment. So I expect there'll be more people looking for those kinds of services going forward, because filling those gaps in the spreadsheets that you get delivered is really important, it seems.
Absolutely. And what I like about RMS's approach at the moment is that it's very flexible. So we are able to spin up services in a very quick fashion to support our customer base in the way they need the support.
Sure. So yeah, back to hurricane season this year, and so what does RMS see as sort of potentially key issues for reinsurance and ILS players this season in particular, and especially through the lens of the COVID-19 pandemic and the extra challenges that could bring?
Yeah, I think it's a great question. I think those issues are certainly going to be a function of what we refer to as post-event loss amplification, which essentially means that there's different factors out there that are causing claims costs to exceed the normal cost of settlement due to a variety of economic, social, and operational factors. A couple of examples is that if there was an event that took place during what we would consider a lockdown period for COVID-19, then it would certainly be difficult for claims assessors, claims adjusters, or repairers to actually get there and assess a damaged property. In this case, that might result in claims inflation or demand surge or even deterioration vulnerability. And then likewise, if there was an event that took place after the lockdown period, which could be during the peak part of the hurricane season, depending on where we are, there could be high levels of unemployment in the construction sector. That could mean reduced pressures on demand surge, but at the same time, it could lead to an uptick in things like assignment of benefits, thereby raising the cost of a claim and the loss adjustment expenses that go along with it. And the last example I would give is in regard to business interruption. Many businesses are suffering and will be suffering as a result of the lockdown. So if buildings are damaged by an event, whether it's a hurricane or something else like an earthquake or a flood, there might not be as much appetite to rapidly reopen that business, and therefore the cost of BI would climb and be a little more amplified than we would normally see in usual circumstances.
Yeah, and that's actually something that's been raised in the last few days with relation to the riots in the US as well, that there could be some incentive for people who haven't been able to claim BI for the pandemic to kind of remain shut for longer than they perhaps would have under a normal circumstance. And I guess the same goes for any catastrophe event as well. Seems social factors are going to play into all of this. It's also clear that the pandemic's almost changed the exposure profile for the industry to a degree as well, in terms of stranded and parked assets and anything from aviation to marine, and also the fact that properties are less protected, and potentially that can lead to the loss amplification you were talking about as well, which can also add to the risk to lives and on top of the financial costs. How do the RMS models help sort of ILS and reinsurance markets to understand those changes to exposure and what it could mean for industry losses from any events this year?
Yeah, absolutely. From a general standpoint, RMS can certainly advise our client base on how to consider the impact of various natural catastrophes plus COVID-19 on various expected cat risk costs through the end of the year. But some examples of how we would actually do that and how it's manifested in our model science is our models do have a lot of flexibility for our users to conduct sensitivity tests and essentially generate their own view of risk for situations like this. For instance, within our North Atlantic hurricane models, users can adjust different damageability assumptions to reflect some of these theories, some of these ideas that you've just presented, Steve. Also, there's ways to manually amplify, I suppose, PLA settings, or adjust different mobility and salvageability assumptions for some of those exposure types that you referenced to reflect just how much more likely or unlikely those exposures are to be moved out of harm's way, or maybe they're still within harm's way, especially in the path of a landfalling hurricane.
And I guess for people with portfolios, Jin, there's a need to look at what they've already underwritten earlier this year as well now.
Absolutely.
Perhaps reassess it.
Absolutely, and I think it's worth noting that the risk may not necessarily just be increasing in one particular area. So if there is a accumulation of cruise ships or planes, because that may be offset by the reduction in liability risk. Now these cruise ships are not out at sea; the planes aren't out in the air. It may well be an unequal trade-off, but it's definitely worth considering sort of the share in risk between liability and the physical risk. The other point I wanted to note was that for our industry loss estimates, the RMS industry loss estimates, which are calculated a few weeks after an event, one component that feeds into it is our on-site assessments. Now, assuming lockdown measures allow for it, and we are able to go on-site and perform that assessment, that is a key component that feeds into the industry loss assessment. And if we're able to see a material difference in the exposure at that time on the ground, then that's where it'll be noted, and that's how it will feed into our sort of loss estimates for the events that occur this season.
Yeah, because you guys provide sort of regular reports when storms are actually in the water as well, don't you, as they're approaching land, including sort of forecasts of losses, but also I know your reports that provide details of 1448 catastrophe bonds that are potentially exposed are also very interesting, obviously, and useful to ILS investors and fund managers. How's that service evolved in recent years? I mean, I've seen it every so often, but I haven't seen whether you've been updating it in the last year or so. And what else does RMS do that can help investors and fund managers as a storm is actually approaching?
Yep, I can address and talk a little bit about our hurricane event response solution as a whole, and then I think Jin can take it one step further. But yeah, essentially, alongside our probabilistic models, RMS does offer a variety of event response products and tools that are widely used and valued by our client base to respond and understand their losses quickly, whether it's leading up to or following the events. And for hurricanes specifically, we provide a suite of products and tools to go from anywhere from having a qualitative understanding of potential impacts all the way through to accumulation, modeling, and eventually an industry loss estimate. And one example of that is, every day as the storm gets closer to landfall and even post landfall, the team develops and releases, stochastic events that best represent the storm in question for all of our clients across all of our market segments to make use of. Now, complementing the hurricane event response products is a suite of what we consider to be premium event response products. That would be our H-Wind product suite. And these products offer additional insight, additional information leading up to and following landfall to help essentially complement what we would produce in the standard event response space. And those products include various forecasting deliverables in terms of providing forecast scenarios, snapshots of the wind field as it's evolving, and even trailing footprints. So essentially, someone has a good idea of what the storm is doing, what the storm has done, and what the storm could be doing over the next, say, 5 days, right as it's evolving throughout the basin.
And Jin, how do you see the cat funds using these tools at the moment?
Yeah, so the daily event selection that Jeff mentioned, that's what we use to quantify the impact on the cat bond library. So we maintain the market portfolio, so it's kept live and maintained, And that event selection is analyzed against the market portfolio, and then we can produce a daily Excel report that shows all the bonds at risk and the revised attachment probabilities. And we realize that it's a really valuable service to our customers. They really appreciate that because it's useful when it comes to answering the questions that they're being asked from their investors on the impact. This year, we're actually extending the insights, and now we've got this notion of a conditional probability of attachment based on a given level of industry loss. So sometimes some of the questions that the ILS managers will be asked is that, well, if this event isn't a $5 billion or a $10 billion event, but it's a $20 billion or a $25 billion, what does that mean to my Cat 1 book? And so we're able to show the revised probabilities of attachment based on a given level of industry loss, which I think would be really useful and provide the insights needed to answer those questions. The daily event selection is delivered as a risk profile through the MU platform, which is our ILS modeling platform, and that then allows the managers to also analyze their private transactions. So this is not just for cat bonds, but the managers themselves can manage all their fund strategies and provide those insights to their customers and also as needed to their senior managers. And what I really like about the event selection process and event response in general is how it feeds into our valuation service. And so what I found typically is that, for let's say a given sidecar, the first actual loss reports, cedent reports, are available maybe 3 months after the event. And so there's this period between time equals 0 and 3 months where the event response service can be utilized to then determine the NAVs, the asset valuations. And so whether it's the whether it's pre-landfall, at landfall, or post-landfall, those event selections, depending on the timing of those NAVs, can be utilized to really calculate a meaningful number, which, as you know, is very useful for the market.
Absolutely, yeah. No, I know the ILS fund managers get significant numbers of questions from their end investors as any storm forms, even relatively minor ones. So having access to data that can give them some idea of potential future impacts is really important. And also, I guess the cat bond information that you provide is very helpful to people who may have portfolios who are perhaps not such specialist investors who may want to see them marked almost more frequently, I guess, to a degree.
Exactly. Right.
Yeah. Interesting. So one of the things that we see with the forecast this year, and also just the climate conditions, it looks a little like sort of close into the shore storm formation and intensification as well may be a factor again. And we've seen this in the last few seasons. I think that there's actually been some storms that have really intensified rapidly as they got closer into shore. It's a more challenging thing perhaps to model for, but how does RMS sort of account for that, and what services do you provide around that to help investors understand sort of the risk?
Sure. Well, the stochastic event sets within the RMS North Atlantic hurricane models are designed to reflect the full spectrum of plausible loss-causing events, including those that form and intensify quickly before making landfall. So that could be like a Hurricane Harvey scenario of 2017, or even a Hurricane Michael type scenario in 2018, as well as those types of storms that have various rates of filling or weakening once it's over land. So, we have storms like Harvey that we know parked and essentially stalled over land once it made landfall. And then we have storms that move much more quickly once they make landfall, even if, they've intensified quite rapidly just before landfall. So our models certainly reflect the full spectrum there of what we consider to be plausible loss-causing events. But alongside those probabilistic models, the H-Wind forecasting products that I alluded to in the previously, those also supports real-time hurricane event response decisions, and some of the things that we're looking into, some of the updates that we're making to those products this year is to incorporate a methodology that better reflects the likelihood of a storm to undergo rapid intensification, a la Hurricane Michael, before it makes landfall. So that way, the products that are released to clients do reflect that likelihood, and and those types of products can be used to make decisions is far ahead of landfall as 5 days. So collectively, I think these products, these updates, will help the ILS sector make more informed decisions when it comes to identifying contracts at risk, or buying and selling live cat coverage, cat bonds, or ILWs leading up to landfall.
Yeah, no, it seems quite interesting, the H-Wind product, and how that ties in with the data provided through your MU reports as well, because you're getting a picture of the potential loss that emerges, but at quite a granular level, I guess, with that sort of two services as well. Mm-hmm. Interesting. One of the questions I always get from people in the ILS market, but also the traditional market, I guess, as well, but especially from investors who maybe aren't specialists, I suppose, in reinsurance or catastrophe risk, is about differences in data outputs from model vendors, different vendor models, and how that affects metrics to do with transactions and things like that. And it's something I always try and explain to people, but I'm no expert, so I thought it might be interesting to hear it from the horse's mouth, so to speak. How do you explain that to people when you get that question? I'm sure it's something you hear a lot.
Yes, it's a very commonly asked question, but a very valid and a fair question, because we know that model loss estimates in the market have a significant and real impact across all market segments. And there's also a wide range of model loss estimates that have been issued for recent events. The RMS approach is intended to be fairly measured and considered, where we understand that there's a need out there to release timely insights as accurately as we can. So that's what we try to do. We want to release our information to the market in a timely manner, but in a way that instills confidence and accuracy in the information. At the same time, when those numbers are out there and you're trying to make sense of them, it's important to know the assumptions and the uncertainties that are informing a model loss estimate. For instance, how is that model loss estimate developed? What kinds of observational data sources were used? Certainly, what is considered to be a modeled and a non-modeled component of the loss? Does the loss estimate reflect any reconnaissance learnings, where you might have a team of folks or engineers go on site to survey the damage and then send those learnings over to inform ultimately the model loss estimate? And certainly the exposure and penetration rate assumptions. So there's lots of different questions to ask when you're trying to understand and make sense of these estimates and compare and contrast them throughout the market. One example of just the value and the importance of things like observational data is in regard to Hurricane Maria. We know that 2017, when Maria made landfall in Puerto Rico, there were a lot of stations that went down and thus couldn't record the peak wind speeds. However, there's other ways in which you could fill in those gaps, and we're lucky enough to be able to utilize some of those sources via the H-Wind product suite to make sure that the gap in station coverage didn't necessarily mean a gap in reflecting and capturing the peak wind speed associated with those events. So just a flavor of some questions to ask, questions to consider when anyone's out there trying to make sense and understand what's behind that model loss estimate.
That's interesting. Jin, from your work with ILS investors specifically, how do you approach that?
Yeah, I mean, just a couple of quick points to add to that. What's really nice about the way we approach the industry loss estimate is that we're very clear in explaining what is modeled and what is non-modeled, and that's really useful, because we understand that this information does have a downstream process to it, and the managers themselves will be sharing it internally, and then again, as we spoke about before, with investors who are asking questions. And so we also understand that the industry loss estimate has value in performing a sort of top-down market share analysis to figure out which programs are at risk. And so again, as Jeff explained, getting that balance between being fast and considered is really important, because of the way that industry loss estimate is used to identify those programs.
No, absolutely. It's always a question, I think, for people when they're coming to looking at how they understand the analysis around perils like hurricane risk. There can be obviously quite significant differences in methodology and things like that, so it's useful to understand a bit more about what's actually behind that as well. And I think that's the key thing. People need to take the time to go and understand the methodology that they're looking at specifically. Back to H-Wind, because it's one of the products I've known of for a good few years actually before RMS purchased that company. I find it really fascinating because obviously it provides this quite detailed wind footprints, which you then use to produce sort of loss footprints and things like that as well. Which to me, with my sort of less sophisticated hat on as somebody watching the industry, always thought that makes a nice trigger. But what else do you see from that product that's useful for the ILS markets?
Yeah, I think it's a great question. And yes, since we brought H-Wind in-house back in 2015, 2016, we've invested a lot in building out the product suite as best we can. And one way we've done that is through developing these forecasting products that we've mentioned a little bit already on the interview. So the forecasting products are really cool because they use real-time storm data from a variety of domestic and international weather models to generate a series of 5-day forecast tracks, scenarios, and footprints. So we're collecting all of this data and consolidating it down in a way that can be, distilled and accessed and used by our clients. These products are made available every 12 hours once a tropical cyclone in the North Atlantic Basin has been named. So once it reaches tropical storm status, and these scenarios are not just providing insight into the track or potential hazard impacts throughout onshore regions. It's also providing information on potential losses. So you can use these products to understand industry impacts as well as impacts to specific exposure types at risk, depending on the book or the books you're trying to run. So it's trying to encapsulate and include all the different aspects of what we would consider to be impactful components of a storm. And this year, one of the ways we're building on that first version of the forecast that we released last year is to release more forecasting products throughout the day, throughout the course of the storm. So we'll be doing that in a more frequent basis, and also incorporating a storm surge component to what was previously just a wind only set of forecasts. So it's quite exciting. We're looking forward to rolling that out in earnest. We've already seen a couple of storms develop in the basin, so we'll be excited to release these types of insights to the market over the coming weeks and months.
Yeah, that's interesting. That sounds like something that will be very useful for people when they're considering live cat trading.
Exactly.
That's the kind of information you need to really make an informed decision about whether to buy some protection at the last minute or not. So, very interesting. I guess it'd be remiss not to talk about catastrophe bonds. Now, obviously, RMS is involved in providing calculation services and risk modelling services for those. You've been involved in a few recently, I know, but you've also in the past provided sort of both modelled loss and parametric data for cat bonds as well. How widely is this sort of stuff being used? I guess on the private basis as well. Is this something you see quite a lot of activity going on at the moment?
Yes. So RMS has a very long history using model loss and especially parametric triggers for catastrophe bonds. It's a long history of innovation. That they're the sort of things that we like to point to as firsts for RMS, whether it's Japan typhoon triggers or flood triggers in the US. And we're quite proud of our history and our innovation in that space. And because of the flexibility and the openness of our models, we can isolate the stochastic event set and the hazard and produce exceedance probability curves just on that basis. So we have an application called Cat in the Box, which is available online. It's based on Google Maps, and our customers can log in and draw a shape, or whether it's a circle, square, whatever it may be, to dissect the stochastic event set. So, hurricane tracks for wind and earthquake sources for quake. And from that, we'll produce a EP curve based on that hazard. So, for example, what is the probability of exceeding 70 miles per hour for a particular shape in offshore wind? And for perils outside of the US, again, we can provide services that are really flexible to access that data. And you're right. I'm working with a number of MGAs right now. It seems like there's a little niche being carved out by MGAs in the parametric space, and I'm trying to provide services, data, tech, whatever they need to get them up and running, and supporting their growth as best as possible. So yeah, we're seeing it both on the public cat bond side and on the private transaction side.
Yeah, it's interesting. There's definitely a bit of a resurgence in interest in parametric products at the moment. I think helped by the last few years of focus on protection gaps as a whole. Now there does seem to have been a realization that finally actually parametric triggers can plug some of those gaps quite effectively as well. So I would hope to see more of those transactions coming to market. So before we sign off, are there any other sort of products of relevance or areas of relevance for the ILS market specifically that you'd like to mention?
Yeah, so we actually held the RMS annual conference last month. It was a virtual conference, as you'd expect, and this was a chance to introduce a new application called Risk Investor IQ, which sits on risk intelligence. And so this is our sort of next level of capability to support ILS pricing and portfolio management. Some ILS managers are already using it, and we've had some really good feedback. It all runs in the cloud, so you've got some really super fast run times. And some of the feedback that we've had is around the structuring options. So we've got drag and drop templates, easy to model reinstatements. You can visualize inuring layers. So if you think of a tower and the loss is running from bottom up all the way to sort of the top layers, the cat bond layers, that's really easy to see and then run sensitivity tests on. So we're really excited about it. I think it's going to be officially launched in the summer. The other piece of feedback that we're getting through is the APIs. And so, as I was saying before, we've got the head of tech and the head of analytics now, and they're really looking at ways in which they can take RMS services and weave them into their internal workflows. And so this is not just about touching an app on a web browser, but really figuring out neat ways in introducing RMS into their internal workflows. So really excited about this and really looking forward to helping our customer base make that transition from what they use today to something a little bit more capable in the future.
Yep, and if I could just add to what Jin said, from an event response H-Twin standpoint, we've had a number of discussions with clients and the broader market over the last year and change, and we've listened to a lot of that feedback. And one of the big things that we're trying to do and do more of is to bring these products, bring these insights to our clients faster. And one of the ways we're doing that is to start integrating more of these event response products, H-Twin products, into risk intelligence, into the applications to shorten that process from when the products are created to when the products can be accessed and used. So that's one thing we're looking forward to building upon this year is rolling and integrating these products and tools into the new platform here at RMS.
Sounds very cool. Good to see new developments coming. Hopefully these things will help people to better understand the hurricane season as it progresses, and obviously hopefully we'll have a less impactful one than we've seen recent years. But as ever, people at least can try and be prepared thanks to data services and analytics like your own. So Jeff, Jin, thank you both for your time. Really appreciate it. Good to see you both, and hope to talk to you soon.
Thank you, Steve. Thank you for having us.